put options gains. Put options gains, ladies and gentlemen. In this video, we are going to be discussing a different look at cash secured put options gains. But I got to give you a warning. A big disclaimer for this video. Are you ready for that warning? Let's move into it. I'm going to use a real stock so you can see real numbers. However, I don't know your situation. I don't know your background. I am not a financial advisor. I have no legal certification. In no way whatsoever is this a recommendation for you to do anything with your money. It is just for educational purposes and so you can see real numbers. If you were to do exactly what I'm telling you to do, there's a chance you could lose money. So let's take the worst case scenario. Let's take the worst case scenario. Do not do this. You will lose money. There's a chance you will lose money. So the worst case scenario is you will lose money. This is just for educational purposes. If you're okay with that, let's take a look at it. Now, we're going to be looking at this stock, H&R Block, which closed at $35.46 today at June 1st. In this theoretical example, we're going to be imagining that we have $4,000 in the account. We are going to be selling a cash secured put option. So that means that we need to choose a strike price that's going to be less than $40. So let's look at that. So here we're going to short, which means sell, put option. And this line right here, this is the different numbers the stock can trade. So let's take a look at an even number, $30. We see there's a pre-selected price here, or a timeline here of 16 days, potentially selling an option that will expire in 16 days with a strike price of 30 and getting paid, we'll go down here, getting paid potentially 15 cents to do it. Now remember, these options in the stock market are in increments of 100 shares of stock. So that's not 15 cents, that ends up being $15. Yes, some commissions might be taken out, but for this scenario, we're not going to deal with commissions. Just really easy. So then, now you have $4,000 in the account, so that means we could pay, if we were to get assigned, we would pay $3,000 to buy this 100 shares of stock, and we're getting $15 to do that. So let's say we sell this. We sell this contract. Now here I have a spreadsheet that shows a ticker, and our ticker is going to be HRB, and we haven't bought the stock yet. We just took in a credit of $15. Now you see over here it shows we have $15 value, right? So now let's say our time goes by, our 16 days goes by, no assignment. Okay, so what does that mean? That means H&R Block in the 16 days that we had this contract open, it stayed above $30 and it closed above $30. So we sold a cash secured put option and it expired worthless. So let's say now, obviously now we have $4,015 in our account, but let's say this time we want to go a little closer to the money. We want to go up here at 32. We'll still stay with this 16, and we'll go with 27, which isn't in the middle. Let's say we do this, we sell it. Now let's add this into here. So again, we're doing H&R Block. This time we got $27, right? Now you see the total value that we've made so far from H&R Block is $42 of income has come in. Now let's say at the end of this particular 16 days, let's say H&R Block drops down several dollars and ends up closing below $32. It doesn't really matter at this point what it closes at. It could be down here at 23, it could be whatever, because what matters is we're going to be buying it at 32. That is the agreement that we made by selling it at the strike price, right? To get paid this money. So now we go back over here, HRB, and we go to stock bought at 32. Now you notice here that we bought H&R Block 100 shares at $32, but our value here shows $31.58. Why is that? Because 32 minus 15 minus 27, well, 32 times 100 shares minus 15 minus 27 equals this. Now let's say the next step of doing something like this. Now we're moving into the next step of, after selling a cash secured put option and being assigned, now we're going to do the opposite. We're going to sell the call. I know it's not something we talked about a lot, but let's use that imagination a little bit, just to bear with me here. And so now we're going to sell a call, which means that we'll look at the strike price 38. If H&R Block trades over 38, then we will sell our shares at $38, even if it's trading up here at 46. We're making a commitment. And for doing that, we're going to get paid. Let's say we ask to get paid $25. So let's take a look at that. So now we got that H&R Block. We took in a credit of 25. Watch what it does to this number right here. Lowers that number just a little bit. This is what we're going to refer to as our cost basis for the stock. And now let's say H&R Block keeps trading below the price that we bought it at, right? Keeps trading below $32. And you notice we've been selling these contracts for 16 days, which we could say is about 2 a month, right? I know it's a little bit over 2 a month, but let's say we drop it down to 15 days. And I know there's some days in a month, but let's just keep it simple. Use the imagination so we can go from everywhere and figure out how to go from A to B at the same time, right? So what we're going to do to expedite this, so we are going to go back over here. I'm going to use my handy dandy cell phone calculator here, and we're going to say we've been getting, just to keep it simple, we're getting $25 for selling a call option, and we're doing 2 a month. So that means $50 in a month, right? $50 in a month. Now let's say H&R Block keeps trading below $32, and we continue to do this for a total of 12 months. So $50 per month, right? 25 2 ends up being, we're doing that twice. So that's 50 times 12 for the full months. So we'd be taking in a total of $600 for a year of doing that. So let's put that in here. What does that do to our cost basis? Watch right here. Drops it down to 25. Right? So put options gains, right? Put option gains. Why, even though we're selling covered calls right now, why is this still put option gains? This is how we started here. We started selling cash secured put options, right? And that's why I keep talking about to sell cash secured put options on a stock you wouldn't mind owning the rest of your life if you had to, at a strike price that you wouldn't mind buying it at. The only way doing this, the only way you can lose money is if the stock goes out of business. Now, something else about H&R Block is they give dividends. So if they give dividends 4 times a year. If we've just done this for 12 months, we've got 4 payments of dividends. Let's say that's going to be another 25 bucks. I have no idea what it is. Let's just do it to make the math easy. Watch what happens here with our cost basis. Right? Moves down just a little bit. Just a little bit. What was it at? We'll take that out of there. It was at 25.33. Put another 25 in there. Now we're at 25.08. Can you see, if we keep doing this, we keep collecting dividends and we keep selling call options against it, that sooner or later this number goes down to 0. Our cost basis goes to 0, but we keep collecting dividends and we keep selling premium. So eventually we have our $3,000 back in our pocket, or excuse me, $3,200 back in our pocket. We still have 100 shares of stock, and we're still collecting dividends, and we're still collecting premium. Well, let's say one of these times, H&R Block, we're selling calls against it at up here at still at 38. Right now, let's say it trades way up here. Finally, it moves up there, but it takes say it takes that 12 months just to keep our example here, really simple. So now we go over here to sold. We sold it at 38. Total profit here, including the dividends that we put in here and these things. So it might take time, but you're in a pretty safe position, assuming that the stock doesn't go bankrupt, right? That's really the only thing that could throw this off, is that the stock goes bankrupt. So either way, you either drive your cost basis down to 0, then you still are collecting dividends. You got your initial investment back, and then you're still collecting dividends, and you can still be selling puts against it. Or at some time, the stock goes back up, and you cash out. So that is a different way of looking at put options gains. Logic is going to get you from A to B. Imagination is going to take you everywhere. See these scales? We want to combine those. We want to balance the logic and the reason to make sure we can go to A to B. But where do we really want to go? We want to go everywhere. Everywhere consists of A to B, a lot of little A to Bs. So you want to balance this. This might not be what you were thinking about, but there is some of the greatest wisdom that I've ever learned is this idea of an infinite return on investment. Can you believe that? Put options gains, an infinite return on your investment. So think bigger. Think bigger than just selling one contract. Think about what Warren Buffett says. Rule number 1, don't lose money. Rule number 2, remember rule number 1. Think about these things. And if you want to have a little more insight into selling cash secured put options for income, click the link in this video where I go over more detail about it. And if you want to really, really bring things to the next level, I suggest you go to ihavesuccess.com, get yourself a copy of this 3 underused tactics to transform your financial results. I use these tactics myself. That's how I know they're underused. I've been alive for 45 years, walking on earth as of the recording of this video. I've met a lot of people, and I don't know a lot of people that are using these. Do other people use them? Yeah, that's how I found out about them. But they're underused. Don't be someone that's underusing them. Go get your free copy. Start implementing. Start implementing these things. No matter what you want to do. Sell put options. You want to sell National Geographic magazines door to door. Whatever. I don't care. Implement these things. It will change your life if you allow it. You guys have a fantastic night, and I will talk to you later.